Today we'll look at using a whole life insurance policy to practice infinite banking, and we'll look at this with a smaller whole life insurance policy. What we're going to look at specifically is someone who is funding a policy with $10,000 per year. And first we'll look at funding a policy for a period of 30 years, and they'll look at taking loans during this funding period, meaning they'll continue to fund $10,000 per year. They're starting at age 30. They're going to fund until they're 60, and they're going to take a loan of $30,000. That'll be for a car purchase, and then later a $100,000 loan. And during this 30-year period, they'll be repaying those loans. And then what we'll look at is the exact same policy, but stopping funding after 5 years. A lot of people like to do this, and the reason why is because they can then just focus on loans. So in this particular case, we'll look at a $30,000 loan, just like the first example, but you'll notice here, the $10,000 per year payment stops altogether. Now they can focus 100% on the outstanding loan, and then they'll take a second loan, in this example, for $60,000 and focus just on repaying that as well. Let's get on into it and have some fun looking at some life insurance illustrations. So we're just going to look at the numbers on Excel in this particular video. So what we've got on the left is the example with no loans. You'll see $10,000 per year. How you can tell that this policy is designed for maximum cash value is look at the first year. You're at 92% of what you paid into the policy available in cash value, and your break-even point is year 4 in this particular example. She's paid $40,000 total by year 4, and she has $40,000 in cash value. This is on a 30-year-old female. So what we're going to look at next is taking policy loans. Here we go. So what you'll see here is the exact same policy. Everything is identical. Notice by the 4th year, your cash value and death benefit is the same in both illustrations. Okay, the difference is we're going to take that $30,000 loan. What you'll notice is you have a $30,000 loan balance now. The first year, we make no payment at all in this particular example. We can, but we're not going to do that. When you take a policy loan, the amount that you can borrow is based on what you have in cash value. So before the loan, you had $51,500. After the $30,000 loan, you have just about $20,000. Before the loan, your death benefit was $471,000. After the loan, it's $441,000. It's reduced by exactly $30,000. Anytime you take a loan, you'll notice your death benefit will be reduced dollar for dollar. Then we look to repay the loan. In this particular example, we're going to repay it at $5,000 per year. That is the total payment she's making. This is in addition to the $10,000 per year she's paying into the policy. Now, of that $5,000 per year loan payment, in purple represents how much is applied to the loan principal, and in red represents how much is applied to the loan interest. As you repay a policy loan, you'll notice that your cash value and death benefit are restored. And if we look at the bottom of this example, your cash value is $184, your death benefit is $785. To the left, where you never touched it, your cash value is $184, your death benefit $785. Exactly the same. You receive that constant compounding all the way through. Now she takes her second loan of $100,000. Just like the first example, you'll notice the cash value is reduced when you borrow, and the death benefit is also reduced when you borrow. Now she begins to repay it at, in this example, $1,000 per month. And what you'll notice, she's repaying it. How much goes toward principal? How much goes toward interest? Cash value and death benefit being restored every year as I make those payments. And once it's paid in full, check this out at the bottom, cash value and death benefit 100% restored to exactly what it would have been as if I never touched it in the first place. The money keeps on moving. All right, ready for example number 2? This is the example where she stops funding the policy after 5 years. So here, no loans to the left. The difference, stop after 5 years. To the right, to the 4th year, everything's identical when you look at the cash value and death benefit figures. Then we take that $30,000 loan. We see the exact same pattern that we saw in the last example. We pay it back here at $10,000 per year. The last example, we paid it back at $5,000. Why we're paying it back faster is because we no longer have the payments here. So now she can just focus solely on the policy loans. When that loan is repaid, there's your cash value, there's your death benefit. When you compare them to the example where you just let it sit and grow, everything is 100% restored, which is sweet. Here's your 60K loan, nice. You'll see the cash value and death benefit reduced accordingly. And then when we pay it back, what happens? What you'll see is your cash value is 120, your death benefit 321, which is identical to what we see on the left. And long term, we see the same thing. So the main item to be aware of is that our money keeps on compounding even when we borrow against the policy. And this policy does illustrate 10K per year going in. However, her minimum premium is closer to about $100 per month. And then everything up to the 10K is going into PUAs, which makes the policy very flexible, meaning she's not on the hook to write a check for $10,000 every year. I hope you enjoyed this video. I'd love to know your thoughts, and if you like shorter videos like this that just focus on the numbers and get right to the point. And as always, I hope this helps.